stock market was not sensationally overpriced, but it was a big overpriced bull market. It was not in itself a bubble. The housing market was a bubble, a beautiful, magnificent bubble. And if you look at it, it's perfectly round. It goes up for 3 years. It goes down for 3 years, exactly the same speed. And it goes all the way back where it came from. And the housing bubble inflicted about $10 trillion of loss of perceived value. So 1 minute you thought your house was worth 400,000. 3 years later, you were told it was worth 550,000. 3 years later, you were told it was 400,000. And 2 years after that, 350,000. So you had lost an enormous asset. And housing markets are much more dangerous because more people own them. The middle class in particular that owns very little stock owns a lot of housing. And it really, when you lose that value, you skip the trip to Portugal and you realize you can't send your second son to private school. And it really flows through the system. We have 3.5 in bubble land. We have, Jim Grant would say, the most overpriced bond market and the lowest rates in the history of man that go back 4,000 years. There was never a time when so much had a negative return where you pay the government to take your money. So that's number one. Number two, we're a contender for the highest priced US equity market in history. I would say a majority of bubble experts think this is now slightly higher than 2000, which was epic. And some people do not, but at least we can all agree it's a contender. And then we have real estate. And real estate was kind of off screen until a few minutes ago. And suddenly, on some of the databases, it has risen 20% in the last 12 months. Schiller's series, a little more conservative, lags quite a bit. I think it's only up 13, but the other series, perfectly seriously done. Up 20 is the sharpest rise, sharper than the 70s with inflation and sharper than the housing bubble of 2005. And what that means is metric we hero worship is multiple of family income. How much does the median house, the one in the middle, how many multiples of the median family income is it? It's a nice, stable, fair metric. It used to be in America that we'd sell at 3 times family income. And in the bubble, we kind of went to 4.5 or so and then back. And we are now at the multiple of family income that we were in '06, the very peak of the housing bubble. We're back. Now, the rates are very low, so all being well, you can, quote, afford it. What you can't afford to do, if you're a beginner, is buy it in the first place. How painful for most people high asset prices are. They're great for retirees who have nothing to do but liquidate their pile of assets. But for people who don't have it, and for society in general, it's a disaster. Because what has happened over the last 25 years is that the yield on assets has dropped as the price rose. And at 6%, you can reinvest and double your money in 12 years. And at 3, it takes 24 years. So in 48 years, you have a quarter of the wealth, ignoring taxes for a second, a quarter of the wealth that you would have had in the world on average of the 20th century. This is terrible. And the same with a house. You're getting half the house that you used to get for your income. It's a disaster for people who don't have assets. And the whole society is compounding its wealth much more slowly. It's such a simple arithmetic point, but nobody seems to get it. It is slowing our wealth creation down and giving us the illusion that we're all getting rich. And of course, if you have a house, you know that the house hasn't changed. House was the same house at 300,000 as it was at 450 and back to 300,000. It's the same darned house. It doesn't hold off the rain any better in a housing bubble like today. It's the same with stocks, by the way. They're the same old stocks. Only in stocks, you get the fantasy of pretending that somehow their earnings have gone stratospheric. And you can expand the storytelling to fit the available price. And that's why bubbles in the stock market are so dangerous. But when you look back, you find there was no dramatic shift in long-term earning power in 2000. It was just a game we all played. There wasn't even in Japan. There was a fairly modest upswing in profit margins. And profit margins are, as I like to say, the most provably mean reverting series in economics. So if you pay up for rising profit margins, that is absolutely the wrong thing to do. You should pay up for crushed profit margins because they always bounce. You should pay down for heroic profit margins because they always move downwards. Anyway, first time in American history, the real estate market, the bond market, and the stock market. And then coming up on the rails, as they say, are commodities. If you take the Goldman Sachs index for non-energy, they have a ludicrous total index. It's so dominated by oil that when they break out oil and non-oil and the total index, you can't tell the difference really between the total index and the energy part. But if you look at the non-energy part, which is all the metals, all the critically important foods, plus one or two other things like cotton, it's back to the all-time high of 2011. It's back to that epic move in commodities. I mean, who knew that? The broad base of commodities, a lot of them that count, are back to the all-time high. And the UN Global Index of Food Prices is not far off its 2011 high. And then there's a more complicated story of energy, because energy in terms of fossil fuels is in the end game. The paradox, or the slight irony here, I suppose, is in the stock market, where it really is focused most on the US. And although the developed countries are, quote, overpriced, it's fairly business as usual. And there are some countries, the UK, for example, and some would argue Japan, are not particularly expensive. And emerging markets seem to be perfectly ordinary, which means against the bubble US, they're one of the 2 or 3 lowest relative points in history. And from those other points, they have done very, very well indeed. As recently as 2008, the emerging market sold at a PE premium to the S&P, and now it sells at half. And that's a pretty decent discount.
Why does this time seem very, very different?
I am actually hard-pressed to find anything that isn't different. But to start with the basics, the price-earnings ratio of the market for the last 20 years has been 70% higher than the previous 100 years. This is not a small number. This is not 15%. The profit margins of U.S. corporations have been 30% higher in the last 20 years. I think also the style of corporate management. 30 years ago, they used to think about expansion. The market for paper would get a little tight and they'd start to open new mills. Now they think about profit margins more than expansion, and they use their extra money to buy stock back. It works out very well for corporate offices, tends to push the price of the stock up a little bit, tends to be a little bad for GDP growth, a little bad for jobs. But for the corporation itself, it works pretty well, and for the stockholders. And there's no easy correlation between the economy doing well and the stock. You might think there is when you read the newspaper or listen to the news, but there isn't. If you run a correlation between the countries that do well, you can't find any connection. The rapid growing countries of the past have tended to slightly underperform. So you might start with Japan, had the best growth, didn't do that well overall. And then South Korea, China today, they outgrow everybody. It doesn't mean you make more money in the stock market. In fact, you run them all together over the last 100 years, you see a slightly negative correlation. The countries that have grown more slowly tend to do a little bit better in the market. The thing that drives return is how profitable you are, not how fast you grow. I'm causing a lot of trouble amongst my fellow value managers by saying that I don't think this market is a true bubble about to blow up. But that doesn't mean I would put my money in the US market. I think emerging markets is unusually much cheaper than the US. As recently as early 2008, it sold at a premium in the price-earnings ratio. And by the spring of last year, amazingly, it was actually cheaper than it had been after the crash in 2009. And the US, meanwhile, priced at 11 times earnings, had gone to 22, and emerging had gone from 11 to... And that's usually a pretty good sign. You should pay attention, be ready to be a little brave, and the probability of emerging not outperforming the US over the next 5 or 10 years is, I think, very slim. It will win.
Who has the strongest economy in the world, and how do you measure it?
I think, obviously, China and India have been able to outgrow everybody else. And I think that's a workable definition of a strong economy. How many of your poor have you turned into middle class? What is the average lifestyle? What's the average educational standard? And you have to give it to the Chinese. What should scare us a little bit is the success, particularly of the Chinese, of educating their average workforce. Their recent scores in math are higher than the US. Not only are they 1/3 the price or 1/4 the price, but they're actually more skilled in basic quantitative methods. This should make us nervous. It makes me nervous.
Exactly. It makes people in Silicon Valley nervous, too.
I think it does, yeah.
Yeah. And can you argue that over the long run, whatever the long run is, those countries that don't have a highly functioning democracy will be, in the long run, restrained in terms of their prospects?
I have this view about capitalism, that it does millions of things better than other kind of top-driven economic systems. But one or two things it does very badly. If it's very long-term, capitalism is not really suited to that. They have this discount rate problem whereby anything that happens out 20 years doesn't seem to matter. And the Chinese can deal with those problems much better.